So the last time we talked and did a general market overview was just shortly after Russia had invaded Ukraine. Since then, we've seen economic sanctions from various countries ramp up to put Russia in a tougher spot. A lot of that has led to inflation pressures throughout the economy. We've seen our Fed take action, raise interest rates by 0.5 point, and we expect that to continue throughout the year. So I just wanted to set the stage there and then ask your opinion. How do you see this affecting construction in our industry specifically?
A couple of things in our industry that we really pay attention to, like the ABI, the Architectural Billings Index. For the last month, it was up again. It's been up every month since October. Another one of those key market indicators is the Dodge Momentum Index. And in April, it reached the second highest reading ever. And both of those are really things that are forward-looking. For the Architectural Billing Index, what architects are seeing as far as their current fees or their prospects. And the Dodge Momentum Index looks at things that new projects have been put into at least the planning process. And it shows continued growth in the markets that we see: warehousing and distribution, data centers, healthcare, also strength in education, healthcare, hotels. Notwithstanding the interest rate pressure and the material inflation pressures, everything in our industry still looks strong. And talking about interest rates for a minute, there's been a lot in the news. Like you mentioned, the Fed had the 0.5 point increase at their last meeting, and they're talking about another 0.5 point or maybe even 3/4 or a full point by some stories. And that's more than these quarter points that we were talking about last time. And it really is the one thing that they have that's a mechanism to try and slow down inflation, is trying to make the cost of money more expensive than the rate of inflation. And right now that's going to be really hard to do, because even with that 0.5 point increase, interest rates are still very low. And I think something that most people would have a better feel of is like mortgage interest rate. Just this morning I looked, and 15-year rates were about 4% and 30-year rates were about 5%. And it's really only been the last 10 or 12 years that mortgage rates have been that low over the last 50 years. And it's just in the last couple we got used to that 2%, 3% cheap money. And so the news media tends to, I think, exacerbate some of those statistics and numbers because they're newsworthy.
Right.
Yet interest rates are still really pretty low, in the historic frame of reference.
So we see the Fed raising interest rates, trying to slow down inflation. I think there is real fear out in the market about what inflation can do and will do to our industry. But maybe take us through both inflation and what that could do to our trade partners and what that could do to subs, what it could do to our employees, and then also just where we're at with material handling and pricing and delays there.
Probably the most popular indicator of inflation is the Consumer Price Index. And just last week, the Consumer Price Index for April came out at, I think it was 8.2%, down from 8.5% the month before, still extremely high from what we've been used to. And the Producer Price Index also came down from 11.5% to 11%. When we talk about those things that impact our trade partners, that's primarily due to those rapidly rising material prices that are such a big component of that overall index. And to put that in context, prior to 21, if you look back at like years 2017, 18, 19, that Producer Price Index was plus or minus 2.5%. When somebody would ask, what's construction inflation or escalation? And historically it's about 3% a year in, year out. Even with the ups and downs, it averages itself out. When we're seeing 11% for a year, mostly driven by material prices, it really is uncharted territory. And as you mentioned, a lot of that is driven by the war between Russia and Ukraine. Energy prices are a huge part of that. I know I just looked, and Friday gasoline prices hit another record high at, I think, national average of $4.48. I know our local gas station, I filled up both our car and our truck, and I paid $4.89 for regular gas and $5.19 for diesel fuel. And that $5 diesel fuel is what really impacts our business, because all of the trucks and the machines and everything that moves that freight, that's really all run on diesel fuel still today. So that puts a tremendous amount of pressure, not just here, locally, but globally, the impact of the war, I think, is even more so than the US. And you talked about impact on our employees, the price of food in grocery stores and different things being out of stock or low supplies, or you just can't go find anything that you wanted like you used to. And the prices are up 10% year over year for food. And that's a 40-year high as well. When you put that into perspective, globally, food prices are up 30% for the year. Because I just saw something that said, again, because of the war, India, which is like the #2 wheat producer in the world, is stopping exports of wheat because they're just not sure how much is going to be available. And so I think all of those things, impact our business and our employees and everyone else as well.
So shifting gears a little bit, maybe from the cost of goods to an update on what you're seeing happen in the ports, what's going on with container ships, how hard it is to get certain types of materials, and digging in there a bit.
I think that was one of the things that we started to look at very early on in this whole process, when the number of ships off the coast of California started to increase and got to as high as 100. And earlier this year, it was down to about 30. And then has started to climb back up a little bit to about 50. It's still only half of what it was at its peak late last year, yet we can't forget that before the pandemic started, if there were 1 or 2 ships waiting, it was a news story. To put it into perspective, it's still a really big issue. And now combined with the zero tolerance policy that China has enforced, particularly in Shanghai and the surrounding areas, that's one of the busiest ports in the world, it wasn't uncommon for as many as 300 or 400 ships to be waiting to get in and out of one of those central Chinese ports. After the government put the lockdowns in place in Shanghai, that shot up to 1,000, and now is back to about 800. But again, still double what its normal number is in the normal flow of goods.
So we've seen some change in the news also, and we saw a lot of pressure on specifically the industrial market, and a big driver behind that was Amazon and the buildings that they were actually putting online. We saw their CFO come out in their last earnings call and mention that they need to slow down. They overbuild, and it's going to take some time for them to fully use that material. So I'm hoping we see, and we actually already have seen, some relief in the pressure on precast, the pressure on steel, and the pressure on roofing insulation. On the flip side, we have also had concrete projects that are onshoring materials and goods manufacturing to the US rather than relying on abroad. So we can expect some other trades to be affected. What do you see when you look at commodity markets and kind of what you see from the pre-con perspective of other areas we need to look out for price increases?
I think there is still a tremendous amount of volatility, and we've seen that, for example, in addition to the things that you mentioned about Amazon, but lumber was one of those first commodities that we saw skyrocket and then crash. It's done that a couple of more times. So, for example, even just back in March, I think the price of lumber hit about $1,400, and today it's about $1,000. And you look out, at the futures in the commodities markets for the next year, and it settles out around between $750 and $800. And it appears that at least the markets think that's where it's going to stabilize. Now again, that's still double what it was pre-pandemic, but only half or less of what it was at its peak. So in talking about some of the things you mentioned related to Amazon steel, it had peaked about $1,800 a ton, and then right after that information came out for a short time, it really dropped, but now has settled out, at least today, at about $1,300, $1,400 a ton, so down about 25% from its peak. Again, still significantly higher as well than it was pre-pandemic. And some of the other commodities that are related to so many of the materials and pieces of equipment that we buy, the metals, aluminum, copper, silver, nickel, some of those things, they've also all come down from their highs for the most part back in March by that same 20-25% in a lot of cases. That's very general, and yet still significantly higher than they were. That volatility I don't think is gone, and maybe things will level out, but they'll level out significantly higher than we started 2 years ago. I think time will tell whether some of the things we talked about earlier in the economy in general, the interest rates, what that does to people's mood and attitude about building, if that really sends some of those prices lower, or if they will just moderate and level off at kind of a new plateau from where we were a couple of years ago. And again, if you go back to that 3% year over year, so even though we had, call it 11% from last year, if we stay stable for a couple of years, that's that 3% just catching up to itself in 2 or 3 more years. So again, I don't see anything long-term that changes the history that we've seen over the last 20, 30, 40 years or more.
So you did mention nickel among all the other metals that you mentioned as well. So we've got volatility, we're keeping an eye on it, but a big portion of the supply worldwide of nickel comes from Ukraine. So obviously this war has further disrupted its availability. It's critical to car batteries, it's critical to semiconductors. So take us through that a little bit and what that looks like today.
That's one of those instances where the source of the raw material is really at issue because of the war, even though the things that you mentioned really aren't manufactured there. Specifically with semiconductors, most are made today in Taiwan or mainland China, even though the raw materials, the silica, for example, a lot of it comes from Mexico. Really, that individual material of those microchips and all of the things that they power and process is a microcosm of the whole supply chain. When those materials come from someplace, get shipped and manufactured or componentized someplace, and then shipped somewhere else again, a big part of that is why we've seen, at least in publicity, lots of companies talking about onshoring manufacturing back to the United States for a more stable future. Intel, I think, is probably the biggest example that we know of and have been watching because of the plant that they've announced building in Ohio.
And we see that directly affecting us. There was an RFP for concrete, for all the horizontal work there that hit the street the other day, and the rumor is that it will take the full capacity of every ready-mix concrete producer in Ohio for one project. So not only does that create a labor issue for ready-mix concrete companies, it very much affects us from both a labor and material standpoint.
Absolutely. And I'm sure that with people's ingenuity, they will find ways to import material, either for that project or to supplement all the other projects that are still going to want to go on at the same time. I think the impact will be continued higher prices and issues with labor shortages. Now, I think the initial impact on the labor side is that, especially in the non-union areas that will become more expensive and more scarce, we'll probably be a little more protected from that here in Illinois because of the union market that we work in. I know I just saw Ford announced a $7 billion electric car factory that they're going to make here in the US. Mm-hmm. So all of that plant construction of that magnitude will certainly have an impact not only on material but labor. And I think that would maybe be a great place for us to delve more into the next time we talk about what's happening.
So we've talked about a lot today. How does this new information, all these changes, does our message to our clients change?
I don't think so. I think from what we've seen in things we talked about today, the Architectural Billing Index, the Dodge Momentum Index, our industry remains strong. So I think the answer stays the same. We will work to mitigate issues with both cost increases and material delays or difficulties in procurement. In mitigating that, the best strategy is still go forward.
Go forward and go quick.